How's it going today, guys? So what we are talking about today is dividend stocks, and I had like an overwhelming number of people reach out to me and ask me to talk about dividend stocks, and I just wanted to clarify. I had one person ask me to do like a pro and cons list for buying dividend stocks versus other stocks. I'm not going to be including that in this video because I have a lot of information to cover, so I'm going to make that as a separate video down the road. So if you're looking for that video, that's going to come down the road, but this is going to be like the basic foundation of dividend stocks. And after you watch this video, you'll probably know more than most people do about dividend stocks and like how they basically work, what a dividend is. I'll be answering all that in this video here. I just wanted to mention before I get into the video, if you guys are interested, I do have an ebook about my personal stock market trading strategy, and I will link up to that in the description below if you have any interest in checking that out. Let's get going here on the basics of dividend stocks. So the first thing I want to cover is just some definitions here. And if you guys want this, if you want to take notes or anything, I have this all in the description typed out, so you could just copy and paste if you wanted to, or you could just take notes as you go, or just listen to the video to get an idea of what these different things mean here. So to start off, what exactly is a dividend? So a dividend is a distribution of a portion of a company's earnings. So basically when the company makes money, they give the investors a portion of those earnings. They are generally stable and well-established companies. Those are the ones that offer them. So this is a common misconception. Not every company offers a dividend. It depends on how new the company is. For the most part, brand new companies, a lot of them aren't even turning a profit yet, so they're not going to be offering a dividend yet to shareholders. They're generally the well-established companies that have been around for many years and have been making a profit for quite some time. That's when they start to offer up that dividend. Now, dividends basically entice the investors to stick around, and here's why. These big stable companies don't have a lot of volatility, which is a good thing, but it's also kind of a bad thing because if you look at their performance, they don't grow as fast as some of these newer tech companies do, but at the same time, there's not as much risk involved in these companies. But in order to basically entice investors and give them a reason to stick around and continue to hold that stock, they will throw them a dividend as either a percentage or a dollar amount per share that you own to kind of say, hey, this is what we're going to do for you. We know the stock's not climbing as rapidly as some of these hot tech stocks are, but because it's a more stable investment, they're going to give you a dividend to kind of keep you around. That's what the point of a dividend is. Now, a cash dividend is a cash payment to stockholders. And like I said, it's paid on a per share basis, and it's either a set dollar amount per share or a percentage of the stock price at that point when they announce the dividend. And then there's the date of record. Okay, the date of record is basically the cutoff date the company uses to determine who is eligible for the dividend. So they'll set the cutoff date, and if you buy the stock after that cutoff date, you're not included in that dividend, you'd be included in the next dividend. So they use that as basically a point in time where they say, okay, everybody who is holding the stock at this point gets the dividend, and then if somebody buys it afterwards, whoever owned that stock before actually gets the dividend, so you wouldn't end up getting it. They use that as a kind of like a line in the sand for that. Okay, so then we have the declaration date, which is basically just the date the company announces the dividend. That's pretty simple. Your dividend coverage ratio. This is something important, and actually later in the video, I'm going to show you guys how to calculate your dividend coverage ratio. But your dividend coverage ratio is basically a ratio between the company's earnings per share and then the net dividend to the shareholders. So that's a way to determine how much money they're giving to the investors compared to how much money they made off of that one share of the company. And then you have a dividend reinvestment plan. Sometimes these are called a DRIP, D-R-I-P, as an acronym for them, which is basically something that allows you to automatically reinvest cash dividends by purchasing additional shares on the dividend payment date. So that's pretty cool, and I'm going to explain this a little bit later. But anybody who holds a dividend stock, I highly recommend reinvesting that dividend to take advantage of compounding. And like I said, I'm going to get into that a little bit later in the video, so just keep that in the back of your mind for now. And then your dividend yield is basically how much a company pays in dividends each year relative to share price. One-time dividends, these are relatively uncommon. I've never owned a stock that had a one-time dividend, but that's basically a special dividend paid in addition to regular dividends. And then a stock dividend is the same as a cash dividend, but it's paid in the form of additional shares, not in the form of cash. So that's like the basic terminology you should be familiar with when it comes to dividends. Okay, so when a company makes a profit, they have a couple of different options of what they can do. The first one is to reinvest through expansion of the company, reduction of debt that they currently have, or repurchasing of shares. The second thing they could do is pay a portion of the profits to the shareholders through a dividend, or they can do a combination of those two things. Now, dividends are generally paid on a quarterly or yearly basis. So just for example's sake, I hold a utility stock that pays a dividend, and they pay a quarterly dividend. And then I also own, through my mutual fund, I get dividends on that as well. And those are all quarterly, so every quarter they pay the dividend. And I have both of those set up to reinvest the dividend, because as I said, you want to take advantage of that compounding. Not all companies pay dividends, which we already discussed before. They're generally well-established, financially stable companies. And then the other thing is not all that do pay dividends will continue to do so. And here's the explanation to that. Dividends are all based on business performance, and if the business performance changes drastically, that could cause the company to increase the dividend, decrease the dividend, or eliminate it completely. So a dividend is not always guaranteed. So when you're buying a dividend stock, just remember there is a possibility that that dividend could go down or even disappear. It's not a guaranteed thing. And then here's something else to note. This is a common misconception with dividends. People automatically assume a high dividend yield means a stable investment, because they would say, oh, if a company's paying me 7% on the share price, that must be really good. But the problem with that is it's all relative to the stock price, what they're paying. So if they're paying out a dollar amount, okay, let's say they pay a set dollar amount per share, okay, then the stock price falls 50%. Now that dividend yield actually doubles. So it would make it appear as if that company is paying out a ton of money and they're very profitable. But the truth is that dividend yield is only that high because the stock price plummeted down 50%. So a high dividend does not always mean, and it commonly does not mean, a stable investment. It could be signs that there's low future growth expected. It could also be a sign that their company is facing financial difficulty. Now, in contrast, a low dividend is not always a sign of a bad investment. In fact, it can be a good sign. It could be a sign of expectation of future growth. So don't always assume that a dividend is a dividend is not an indicator of a good company versus a bad company. It's something totally unrelated in most cases, actually. So just to explain quick, we mentioned the one-time dividends. Here's the scenario with those, okay? A company will pay out a one-time dividend when there's a sudden increase in cash. And the two most common reasons for that sudden increase of cash is if they sell off a business they own, or significant litigation winning. So if they were involved in a lawsuit, or if they were suing somebody else and they won a significant amount of money, they might pay a one-time dividend to shareholders. Alright, so if you guys aren't getting excited about dividends yet, you're about to. I'll tell you that right now when we start talking about compounding. But first, let's go over some important dividend dates so you understand the difference between these things. For the most part, guys, if you're like investing in stocks and you're getting a dividend, and it's going right back into the stock and being reinvested, you really don't need to keep track of this stuff. But if you really want to be like up to date with your investment and following everything, this is what the difference is between these four dates, okay? So the first one is the declaration date. This is the date that the company announces the dividend, okay? Next you have the ex-dividend date, which is basically that cutoff date we talked about earlier. Shortly after is the record date. And this is the date that you must be on the company's books as a shareholder. And then finally you have the payment date, which is the date that they actually go out and pay you that dividend. And now, so here's like a couple of reasons, or a couple things about people who invest in dividend stocks, all right? So dividend stocks are for investors who would like to take advantage of the regular cash payments and the steady income dividends provide. They like knowing that they're getting that cash payment or that reinvestment of stock or reinvestment of shares into more stock ownership every quarter or every year. that's kind of their investment strategy. It's kind of a slower growth with a longer duration of time. Here's something else to consider. Companies that pay rising dividends are usually financially healthy and stable. So rising dividends are a sign of a healthy, financially stable company. It means generally that they're making more money over time and spreading that wealth to the shareholders. So that's a sign of a healthy company. So dividend stocks are popular among investors close to retirement or young long-term investors. Okay, so why are people buying dividend stocks when they're close to retirement? As we said, dividends are generally being paid out by companies that have been around for a long time. They're more stable investments. There's less volatility for the most part. So investors close to retirement are going to be drawing from their retirement account soon, so they don't want to be taking risky investments. So that's why they like buying dividend stocks, because then they're getting that, they're still getting some bang for their buck. You know, they're getting that cash dividend every quarter or every year, whatever it may be, but they're not having so much risk involved where if they were buying a new emerging company, they wouldn't want to risk their money like that at the beginning. In my opinion, if you're going to make those risky investments, I don't really recommend people go out there and start buying penny stocks and stuff like that. I am going to talk about penny stocks at some point in another video, but the big thing with that, guys, and this is something that people don't realize, if you bought a company that's been around for a long time and you invested in them and the stock didn't perform well and went down, you could sell and get some of your money back. Okay, if you invest in a penny stock of a brand new company, that company could go bankrupt and you could lose your entire investment. That's why I really stress that penny stocks are a very, very risky investment. It's almost the same as going to a racetrack and betting on a horse, honestly. So I don't mess around with any of those penny stocks like that, personally. I trade listed stocks for the most part. You're going to be safer that way. By listed stock, I mean it's on either the New York Stock Exchange or it's listed on NASDAQ. That's what it means if it's a listed stock. Those are usually the bigger companies. Okay, so young investors looking for long-term income, that's basically people who want to take advantage of compounding for the next 40 or 50 years. So let's say you're a 20-year-old guy and maybe somebody in your family, or let's change this example actually. Let's say you were a young kid and then somebody in your family wanted to put together money for you and they decided to invest in some dividend stocks for you. Maybe they bought like Coca-Cola is a big company people would buy. For kids. Disney stock was a big one too. Companies that have been around for a long time that pay dividends. So maybe somebody bought you that. It's kind of a novelty item, but also something that will pay you dividends for many, many years. So if you had that Coca-Cola stock and then you held it for 50 years, the compounding would take place and you'd have a lot of money after those 50 years. So that's an example of young investors looking for a long-term investment. Okay. Now let's talk about, actually first we'll just cover this, DRIPs, dividend reinvestment plans. If your company that you're investing in offers this, you want to look into it, and here's why. It's possible that they offer these commission-free, so when you normally trade a stock, you're paying commission to your broker, but if you're reinvesting, it may be, and it oftentimes is commission-free. The other thing is they may actually offer you those additional shares at a discount. So you might actually be getting a discount on those new shares you're buying because they want to encourage people to be reinvesting those dividends. And the other thing about this too, guys, it's convenient and it's passive. I'm all about passive income. That's my favorite thing, is when I don't have to worry about it and it runs on itself, guys. For me, with the investment that I have, the ones that pay dividends, it reinvests automatically. Once a quarter, I get a statement in the mail and it says, okay, you earned this much money and you got this many more shares of the stock, and it's like, cool, I didn't even have to worry about it. You don't want to have to get mailed that check and then go, oh, okay, I actually wanted to reinvest it. Then you have to go through, buy additional shares, pay commission on that trade. It's just a headache, it really is. So I highly recommend reinvesting your dividends. Okay, compounding. Notice the smiley face. We like compounding. Compounding is great. I'm sure you've heard of the example of, you got two people here. One guy says, I'm going to give you $1 million. The other guy says, I'll give you a penny. It'll double every day for 30 days. A lot of people would take the $1 million. If you take the penny, I don't remember how much it's worth. I think it's like $3 million or more than that. So that's the beauty of compounding. At first, it seems small. 1 penny becomes 2 pennies. 2 becomes 4. 4 becomes 8. At first, it seems like you're not making any money, and the $1 million was the better bet. But after time goes by, you see the amazing effect of compounding. Now that's not a real world example, that's just a way you can understand the principles of compounding. But here's how you can take advantage of compounding investing in dividend stocks. When your dividends are reinvested, investors take advantage of compounding. This is because your dividends are earning you more dividends. So let's say you had 50 shares of the stock, and then the dividend you got paid from those 50 shares was enough for you to buy one more share of that stock, okay? The next quarter, you would earn dividends on 51 shares of that stock. So that extra one share now earns you an additional dividend payment. So that's how that takes place. Your dividends earn you more money in the future. And over time, they add up to a lot more money if you give it a long time to compound. So factors for compounding. If you're looking to understand how compounding works, you need these 4 things, okay? You got to have your initial investment, okay? And then you need earnings of some kind. In our case here, it's a dividend, but it could also be interest. You also need reinvestment of those earnings, and then time, and lots of time. Any kind of investment like this, it's not a short-term investment, guys. I just want to explain that to you right now. If you're looking to put money into if you're looking to buy stock in a company and you're looking to take that money out within the next 6 months, don't buy dividend stocks. In fact, don't buy stocks at all. Just hold on to that money. It's really for people who are looking to invest for 5+ years. Emphasis on the plus. This is a long time that you need to let these things you need to let the compounding take place over time for you to eventually see you earning money from that investment. This is not a short-term investment by any means. I mean, me personally, I do a mix of this. I do have some dividend stocks, but I also do a lot of short-term trading where I'm taking advantage of uptrends and downtrends from stocks based on basically technical stock analysis. There's a lot of different investment strategies out there. You got to find one that works best for you. Okay, so here's our last little bit of information here on dividends. And if you guys have watched this video so far, thank you guys for sticking around. And hopefully this means you enjoy my content. So if you do, please consider liking this video and subscribing to be updated for more uploads in the future like this. Anyways, so this is just something to know when you're looking at a dividend stock of what kind of dividend you should expect. The average dividend yield over the last 60 years on the S&P 500 is a 2 to 5% dividend. That is not anything that's going to make you rich quick. You're not going to be, investing in a dividend stock and 5 years later having your own yacht. It just doesn't happen. This is about long-term growth, okay? So if you're investing in a dividend stock, 2 to 5% is the range you should shoot for, and that's generally a healthy dividend for a stock. And okay, so I want to talk about dividend coverage ratio. And this is a great way to determine if the company can afford to pay the dividend, if it's a healthy dividend, or if they're holding back and they could have paid you more. So I want to show you guys how to calculate this. It's pretty simple. Your dividend coverage ratio is basically the earnings per share, which you can find out looking at the quarterly earnings, divided by the dividends paid per share. So here's an example for you guys, all right? This stock had $10 in earnings per share, and then it paid $4 in dividends per share. So you take the $10 in earnings divided by the $4 in dividends, which gives you a 2.5 ratio. What does a 2.5 ratio mean? Well, I'm going to tell you right now. Okay, a ratio of 2 to 3 means that is adequate coverage. That means the company can afford this dividend. That is a healthy dividend. If the ratio is below 2, that means that the dividend may be cut in the future. There may be a dividend cut on the horizon because the company really probably can't afford that dividend. And then if the ratio is above 5, that means the company is being greedy. It may mean that. Or it also could mean, like we said before, it could mean that they're also working on paying off debt. Remember when I said this before? When the company has earnings, they have different things they can do with it. They can reinvest it in the company, pay off debt, or pay a dividend, or both. So it's possible they're just doing both. So you have to consider everything in the picture. But in some cases, it could be a sign that the company's holding back. They're being kind of greedy and holding on to their money. They're not paying the investors as much as they could have. So that's something I'd recommend doing. If you're looking at a dividend stock, figure out what the coverage ratio is for the last couple of quarters and see. That's a good way to predict whether that dividend is stable or if it's subject to correction. All right, the last thing I want to talk about with dividends is taxes. And I'm not going to lie, guys. I'm not the biggest, I don't have the most knowledge on taxes as most people, as some people do. I'm not a tax guy, okay? I know a lot about the stock market. That's kind of more what interests me, but I do want to cover the taxes just to give you guys a foundation of that. And if you want to learn more about that, you can find out more about it. But I have actually filled out tax forms for, declaring my dividends and paying taxes on them. So I do have a little bit of background in how this works. But basically, any company that pays you more than $10 per share needs to send you an IRS form 1099-DIV, which is their dividends and distributions form. Here's the important part, guys. It is the investor's responsibility to report all taxable dividends, even if the company fails to send you this form. So in my case, the companies that paid me dividends were not paying me, they didn't pay me $10 per share in that year of dividends, so they didn't send me that form. I had to go online, and one of the services that I buy stock through is ComputerShare, because it's reinvesting, because I'm actually an employee of that company, so I'm reinvesting my company stock, and I get a dividend from that. So I had to log into computershare.com and find the form myself. It is available online in most cases, but they just aren't going to mail it to you. So you have to go out on your own and know that you have to do this, and you have to seek it out. Otherwise, if you don't declare your dividends and you end up getting audited, they may come after you for that. So that's not a good situation to be in. So you're not going to pay, in most cases, a ton of taxes. It's better to just declare them and then sleep easy at night knowing your tax return is completely legit. Just what I'd recommend. I can't tell you what to do, but that's what I'd recommend. All right, so there's generally two classes of dividends on that form, and it'll specify on your actual statement where you put the number. But an ordinary dividend is taxed as ordinary income up to 35%, based on how much income and what tax bracket you fall in for that year. But then qualified dividends, I'm not going to lie, I don't know the differentiation between ordinary and qualified dividends. If you look it up online, it explains it to you. But I'm not even going to try to elaborate on that because I'm not actually sure. But it will tell you if it's an ordinary dividend or a qualified dividend. If you want to know the difference, I'm sure there's a ton of resources online that could explain that to you. But a qualified dividend is a dividend where the capital gains tax applies up to 15%. So that's the difference between those two. And then this is something important to note as well. If you have significant dividends, it may result in payments of estimated taxes throughout the year in order to avoid penalties or interest. Because if you're making a ton of money on dividends, they're going to want you to kind of set aside a certain amount of money each quarter to pay the taxes on those dividends, which makes sense. But for most people, the average investor, you don't have to worry about that. Okay, guys, that's pretty much everything you need to know for your foundation as far as knowing about dividends. Like I said, in the future, I'm going to do a video on the pros and cons of dividend stocks versus other stocks you might want to invest in. But like I said, this was something that a lot of you guys had requested that I do a video about, and that's my favorite way to know what videos to do is from the comments below, or when people message me on Twitter or on my Facebook page, because I really want to put content out there that you guys are looking for. There's no point in making videos if you guys aren't interested in that content, so I want to make sure that I'm putting out content that you guys are looking for. And like I said in the beginning, if you guys are interested in my own personal stock market trading guide, I just wrapped that up about 2 months ago when I finished it all up. I have a link to that in the description. There should also be a link that shows up on the side here somewhere. And that's basically my own personal stock market trading strategy. And I've had pretty good luck. I do a lot of swing trading, and my average is about make about a couple $100 each week just doing my swing trading. So that's an outline of my stock market strategy if you guys are interested. But thank you guys for watching this video. Please drop a like and subscribe if you enjoyed it, and thank you for watching.